Welcome. If you are new to investing, learning the basics of equity investment is a great place to start. Understanding key terms like dividend, market order, and earnings per share can make a big difference in your investment journey. Equity, or stock, investing means owning a piece of a company and sharing in its growth. But with it comes a range of decisions that can impact your success. By mastering these foundational terms, you will be empowered to navigate the stock market with confidence. You will start making informed choices and build your wealth over time. So, let's dive into these essential equity investment terms and what they mean for you. The first term is dividend. A dividend is a portion of a company's earnings distributed to its shareholders. Think of it as a reward for investing in the company. Dividends can be paid out as cash or additional shares, typically on a quarterly basis. For instance, if you own 100 shares of a company that pays a ₹1 as dividend, you would receive ₹100. Dividends are especially popular among investors seeking income, as they offer a steady stream of cash without selling the stock. Not all companies pay dividends. Many growing companies reinvest earnings to expand their business instead. For beginners, understanding dividends can help in identifying stocks that align with your financial goals. Next is dividend yield. Dividend yield is a measure of how much income you are earning from a stock relative to its price. It is expressed as a percentage. It shows the annual dividend per share divided by the stock's current price. For example, if a stock is priced at ₹100 and pays a ₹2 dividend, its dividend yield would be 2%. This is a useful tool for comparing dividend-paying stocks. This helps you see which ones offer a higher return on investment in terms of income. However, it is important to remember that high yields can also signal risk. So, beginners should balance yield with other factors, like company stability. Earnings per share is a key indicator of a company's profitability. It is calculated by dividing its net income by the number of outstanding shares. Earnings per share shows how much profit is generated for each share of stock. It gives investors an idea of a company's financial health. For example, if a company earns ₹1 crore and has 10 lakh shares outstanding, its earnings per share is ₹10. A higher earnings per share indicates better profitability, which often makes the stock more attractive to investors. Beginners should pay attention to earnings per share trends over time, as growing earnings per share often signals strong company performance. Next is book value. Book value represents the net asset value of a company. It is calculated by subtracting liabilities from assets. It is essentially the company's value if it were liquidated or broken up today. Dividing the book value by the number of shares gives the book value per share. Book value per share is useful for determining if a stock is undervalued or overvalued. For instance, if a company has ₹10 crore in assets and ₹2 crore in liabilities, its book value is ₹8 crore. Therefore, comparing the stock price to book value can offer insight into whether a stock is trading at a fair price or not. This is especially valuable for beginners looking for long-term investments. Understanding simple ways to trade is also important. A market order is an order to buy or sell a stock immediately at the current market price. It is the most straightforward order type. Market order ensures that your trade is executed without delay. Market orders are ideal when you prioritize speed over price, such as when you believe a stock's value will change quickly. For beginners, it is important to know that while a market order guarantees execution, the price may vary slightly from the last quoted price. This normally happens in a fast-moving market. Learning how to use market orders wisely can help you enter or exit positions smoothly. The next basic order type is limit order. A limit order allows you to set the price at which you are willing to buy or sell a stock. For example, if a stock is currently priced at Rs 100, but you are only willing to buy at Rs 95, you would set a buy limit order at Rs 95. The order will only be executed if the stock reaches your specified price or better. This ensures price control. Limit orders are particularly helpful in volatile markets or for investors looking to buy at a certain price point. They allow beginners to manage costs and avoid surprises in their trades. This makes limit order a valuable tool in any investor's toolkit.